Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for November 24th of 2024. Welcome, everybody. Good to be with you again after yet another week. Hope you had a good one. We're going to get started with some of the data here. We've got import prices month over month. You can see here that the survey was actually calling for a slight decline, and we got a little bit stronger number than what we were expecting. You can see that that red dot here follows a bit of a noisy chain here. And of course, the monthly data can be quite noisy, but I'd say overall we have had some increases in import prices here when we were kind of fearful of more inflation. This has probably more to do with the dollar right here than anything else. And the dollar is very strong right now. And so I think a strong dollar policy with interest rates perhaps being higher, and if you assume that we're going to get more tariffs and that the new tariffs are going to be perhaps a little bit more inflationary, then you might see higher import prices become a thing of the norm to at least some degree, over the next year or so. But again, policy takes a while to implement, and we'll just have to wait and see how the tariffs play out and how that channels into inflation perhaps, and how that channels into higher import prices, which then might even channel into a drop in imports. So we'll just have to wait and see on all that. Here we have a look at that dollar index, and you can see this very strong rise here, really in a relatively short period of time. And of course, it's back and establishing kind of a new high almost from levels that we saw about this time last year, maybe a little bit longer. But again, the monthly data, as I've mentioned often, can be quite noisy here. But it's rather odd, even though it happened last year, it's rather odd to see a jump of this magnitude in the dollar index. But it obviously has a lot to do with the competitiveness of the return on money from a fixed income perspective as interest rates move higher, or perhaps in this case expected to remain higher, then more than likely you're going to have that strong dollar, and people are going to demand those dollars for additional investment. And as you're going to see down the road, we have a lot of foreign interest in our investment markets. Now, with respect to the trade war, again, there's a lot that we don't know, but a lot of people are trying to get their arms around it and have some sense of where things might go here. We also have this chart on the right here. These are transcripts from earnings reports from the S&P 500. And so this represents the number of a moving average, 3-month moving average of the number of mentions of trade war or tariffs or anything of that ilk. And you can see that really over the last couple of earnings quarters here, that's come up quite a bit more. And as you would expect, after the election, it has really spiked. And of course, this constitutes press releases, this constitutes like management presentations at investor conferences and everything in between. So now the IMF, the International Monetary Fund, has tried to put their 2 cents into this. And so basically they're trying to give us an idea of the forecasted GDP impact from a trade war. And this is their base case for 2025 GDP growth. And US is looking a little bit more like 2.2. Now in a trade war situation, that goes down to about 1.8. So about 0.4% of impact from a trade war. And on a global basis, the global GDP is expected to grow just slightly north of 3% next year, and that doesn't change very much. So the feeling is that it's going to have, on a relative basis and an aggregate basis, a more pronounced impact here on the U.S. So having said all that, I think it's really helpful to go back in history and look at this in terms of its relevance to the bigger picture, right? And so obviously trade has expanded tremendously over the last 4 or 5 decades, and there was a time where the world was certainly very protectionist. There was a time where the U.S. was extremely protectionist, and you got to go back to like the Smoot-Hawley tariffs, which helped to drive us into or really reinforce the Great Depression. And This chart from B of A represents the U.S. duties collected in relative terms as a percent of the total value of imports. And you can see that back then, that was a pretty significant dislocation for the overall economy when you drive these tariffs higher, and it has much more of an impact on total imports. But as we get through the years, and we get in here to where we are now, U.S. trade war with China, that went up a bit, but still we're talking about maybe 1-2 full percentage points as a percent of total imports. So again, I don't want to get carried away. Obviously, in the last slide, you saw the IMF's estimation for what the trade war impact could be if it really manifests itself. But again, the economy is going to continue to move forward. I don't really worry about that. I think I think the bigger worry is probably about what it does on inflation. And you could argue somewhat strenuously that that 2018, when we put those tariffs on, that it led to eventually led to inflation. And you might be right about that, but when you're in a pre-COVID kind of competitive environment, a lot of those costs are just not being passed on, and it wasn't as inflationary as people thought it was going to be. Here we have Bloomberg baseline tariffs on the left-hand side. Basically, you've got several indices here, but you're just looking at the tariffs on China are expected to ratchet up. And of course, this goes from January of 25 all the way out through the beginning of 2027. And you can see that this is the Bloomberg. This is a series of economists polled by Bloomberg on what they feel is going to happen. And of course, the estimation here is going to be, overall, it's going to move up because of the weight of China. But, when you look at the rest of the world, it's going to be pretty benign. Also, as we look at what happened during the last trade war, and we've already referred to the 2018, 2019 tariffs on China, you can see how the PCE prices across the tariff goods did spike. And of course, this line of demarcation represents when those tariffs were implemented. And you can see that the prices for those goods went up appreciably, whereas really everything else continued to go down. So, I try to look at both sides of the coin, saying in terms of the value of total imports, this is not going to be like terribly significant, I think, when it's all said and done, but it does have real impacts and it does have real effects that we can't just dismiss. All right, so I always like to show the good with the bad here, and right now we've got a little bit of an uptick in business formation applications. This is a good number if you're tracking the economy. It represents economic expansion. It represents entrepreneurs willing to take on risk and engage in risk endeavors, committing their capital to that. So this is a good overall sign of confidence in the backdrop. Here we have, though, the Conference Board leading economic indicators, and you can see here that they have been down for quite some time. They were expected to be down once again. They were down a little bit more than that. You can see the overall index level continues to slide, and we're at a juncture. It's very odd because a recession should have already happened by this indicator alone, and it didn't. And I do think that some of that was due to the kind of the shocks, if you will, from the pandemic stimulus that just created such an artificial environment for economic balance that it really didn't manifest itself at that time because there was just too much liquidity in the system. But we do care about the LAI. We do care about the trend. The good news is that it does appear to have troughed and is on its way up from a monthly basis, even though the aggregate data, referring to the index, is still negative. All right, well, talk about housing here. We've got home inventory, which is looking a little bit better. You can see that typically when you have, and this is very seasonalized, right? You have more inventory at a time where people are generally looking or moving, getting ready, getting their kids in school, things like that. But what we've seen here this year is that we've had a little bit of an asymmetric response. So we've had really a non-seasonal trend, which I think is really good, even though we've got home prices that are still above trend. You can see that there is a seasonal element in home prices as well, as you list before the peak moving season, and then they tend to come down a little bit. Not every year, but most years. So it is following the same pattern, but at an aggregate much higher level. At the same time that we're seeing a little bit of health here build, because it's good to have existing home inventory, as we know that certainly that affordability is an issue with higher mortgage rates. All right. Well, continuing on the housing theme, what's really interesting here is we have total homes under construction is still weak and is trending down. So, what's interesting is that on the right-hand side, what this shows is new housing starts relative to the total population. You can see where we were before the global financial crisis, and we're still struggling to get up to that point, right? Even though what I like to say is that we went through a decade of underbuilding, which is very, very true, and it's very true on a national basis. And so there has been some effort to catch up, but then that is falling again, and you can see that total homes under construction is in a negative growth phase, and certainly multifamily is in that negative growth phase as well. Here we have home builder sentiment, which I think best is described as kind of continuing to languish within a band. Although if you're a technical chartist, you do like to see that narrowing of that channel, and that usually portends a breakout of some sort. But you can clearly see that pre-pandemic levels are well above current levels of home builder sentiment. So some of this is access to capital. It's certainly not for lack of buyers, but there are cost inflation elements embedded in some of the some of the cost of materials going into houses these days. But the real issue is probably a combination of housing affordability, and it's driving out first-time home buyers quite a bit. But there still is quite a need for housing in this market. All right, now we've got loan and lease growth. This is, we're kind of getting into the banking sector a little bit, and you can see where really things are kind of flatlined right now. I mean, 2.4% is kind of a relative term, but it just shows you that just in aggregate, banking activity is not where we saw it prior to the pandemic. And these things do, have kind of bubbles associated with them, but in this case, clearly, we have seen the valley in the pandemic, and that's come back up, and now we're kind of settling in a range here. So on this slide, we have some more banking data. So on the left-hand side over here, we've got essentially demand. It's a representation for demand for commercial real estate loans, and you can see the different categories here, which makes this chart a little bit noisy. But construction, land development, and all of these numbers are still below zero. So, in the last chart we saw that builder sentiment, or last couple charts, builder sentiment was a little subdued. And overall activity is lower, and you kind of see where that correlates to this data right here, which is still below zero. And so multifamily, non-farm, non-residential structures, you can think office in that group, but that's still a lot of, that's a big category right here. So it can mean a lot of different things. Now, sliding over here, we've got the number of percent of domestic banks tightening their lending standards. So this is kind of what they call the SLOOS data, the Senior Loan Officer Surveys. And you can still see here that even though these numbers have come down, banks are still lending, credit is still available, and so we don't have this happy intersection of capital and borrowers right now, because you've got, even though that's picking up, that may be coming down. there's still a disconnect here between the availability of capital and the borrowing of it. So before we leave the topic of commercial real estate, one thing I came across I thought was really interesting is this chart here. So we've got non-performing loans that are beginning to pick up in commercial real estate, and you can see in the aggregate that number has really gone up every single quarter for the last several years. And so, when we look at credit quality, this is something that we do care about. This is not a percent number, so this is $1 billion. So this, and we knew that we were heading into what we call the debt cliff, where a lot of owners in this space are having to refinance their notes, and we know that those loans, if they're going to be refinanced, if they're still creditworthy, they're going to be refinanced at much higher rates. And so we were already anticipating some of these non-performing loans to begin to manifest maybe a little bit sooner than we thought, but I think this is something we're going to be talking about a little bit more in 2025. So we have a couple of regional surveys. This is the Philly Fed that has been jockeying around the flat line for some time. Just recall that everything above zero, it represents expansion. Everything below zero is the opposite, or contraction. We can see that the survey was clearly a little bit more optimistic than where we came in at. And so the latest data point was reversed itself and went back negative. So, that doesn't sound that great. But one thing the silver lining that I take away from that, again, this is just the Philly Fed. So this is one of the 12 Federal Reserve districts. And the good news here is, even though if you overlay the actual data, which we know just turned down. So, obviously this black line correlates exactly to where this blue line here correlates, maybe slightly different scale here. But what's in the pink, I think, matters, and that's the expectations for 6 months. And you can see here very clearly in this survey that the expectations are really moving higher. And again, if in this data series, it goes back to, let's call it 2015. And, you can see if we continue along this path, we're going to be clearly where we were before the pandemic and immediately right after, when we had that kind of reopening of the economy. So I do feel good about that. Now we've got some Kansas City Fed data. The Kansas City Fed index, which has been negative for quite some time, has remained so, although I have to say that the reading was a little bit better than we expected. So, looking at the trend lines, we got new orders for exports. And so I think this is a sign that, and this is just like we saw in that last chart, the pink represents expectations in 6 months. So not only has the current data been trending down, but the expectations have gone really down into the toilet. And this is clearly a sign of a combination of tariffs and a strong dollar. New orders, on the other hand, expected to tail up a little bit here. And so you can see there is a pretty tight relationship overall with this data. And so when you have a number that's projecting 6 months forward, that generally you're going to see the dovetail here by the actual data. And again, probably down here too. So I do think exports are going to drop. And I do think the demand for imports are going to be impacted by tariffs as well. So I think the issue here is that we're going to see net trade as a percent of total GDP probably continue to drop. Now we'll transition into the investment world, and here we have the American Association of Individual Investors, the AAII bull bear spread, and that's a mouthful, but what this means is that everything above zero represents a bullish sentiment, and we have had that for quite some time now. This tails down, but again, with the monthly data, it can be very, very noisy. So we want this to remain above zero. This is just one of the many indicators of sentiment, but it's one that tends to be often cited, and I do think it's relevant, and it does have some predictive power, but just suffice to say that the optimism is still very much in the investment world right now. Now we talk about gold before we get into stocks and maybe bonds a little bit. So, gold has been on a rocket tear. Now, here we have in 2024, once the election happened, that we saw a pretty decent sell-off in gold. And this is not atypical if you're looking at this relative to 2016, which was the last time that Donald Trump got elected. But I'm not saying that we're going to continue to see a slide in gold, but we also have seen a kind of a decline in ETFs that are holding gold as tracking tools. So I mean, we just see we see some disintermediation. Obviously, prices of gold have come down, but we've also seen fund flows out of gold here lately as well. So I referenced this earlier. Now we do have a lot of foreign interest in our markets. Obviously, we have higher rates return. Now the translated earnings back to these foreigners' home countries, could be a little bit challenged. But here we've seen several consecutive um, months of positive data on this front, and we just have a lot of liquidity in the markets, and that's driving up valuations. But a lot of this liquidity happens to be coming to us from overseas. Now I want to talk about fund flows, which we've started in that last chart, and it's been a consistent theme. So you can look at U.S. equity fund flows cumulative in terms of billions. So you look at 2024, you can see that that number is astounding. I mean, we haven't had this much liquidity flowing into the U.S., not only from overseas, but also coming off the sidelines here domestically, that there's no wonder why we see valuations getting a little stretched here. Uh, and as a result of liquidity, then of course that bids up asset prices. And so what we've got now is the fourth highest S&P 500 trailing price to earnings ratio in the past 124 years. And that sounds pretty weighty, right? I mean, it's something that, I think we should respect this. But let's be fair. This is not your well, right now this is not your father's S&P 500. It has much more of a technology focus. It has much more of a technology weighting than it ever did. And we all know what's being bid up right now are those the superscalers and the AI stocks. And as a percent of the total S&P 500, they are, it matters quite a bit. The top 10 stocks in the 500 stock S&P 500 represent about 30% of the index. And so it is no wonder that we've got really high valuations, but we can't ignore the fact that from a historical perspective, that valuations are pretty high. And I think with that comes the potential for volatility. So, in looking at bonds as well, this is just a symptom of there being a lot of liquidity on the sidelines. We knew that there were a lot of money being taken out of banks and been put into money market mutual funds to go chase those higher returns. And we just saw that we've got a lot of foreign investment that's picking up here, and so that's driving up not only equity but also investment grade bonds. And you can see that this number is just so out of line with the trend lines. It's just not, it really is ridiculous. And it just shows you, this chart alone shows you in a market that is trending from an equity standpoint, and investment grade bonds are kind of a little bit in flux now because of, interest rates seem to be following a little bit of a band. But when you have this much liquidity, that tells you how much is on the sidelines. Couple of interesting charts here. So on the one on the left here, what we have is basically kind of a global GDP number right here. And so this is not a percentage. This is just an aggregate. But what I find really interesting is that you have, from a global perspective, you got the MSCI All World Index except US. That's in the blue line. You can see that their earnings power, corporate earnings, are exceeding the pace of global GDP, which I find very interesting. Then you got the MSCI All World earnings per share, and then you've got S&P 500, which, as I just mentioned, has been very much influenced by the Mag 7 and the superscalers and so on. So you can see that follow the same trends. They don't always happen at the same levels, but you can clearly see directionally they're all moving the same way, and directionally, and I guess not directionally, but in aggregate, they're all moving well ahead of the global GDP, which tells me that these markets are a little bit overvalued, perhaps. But that has been the case in many of these expansions before. So on the right-hand side, we got annual profit outlook, which this shows you the 2025 estimate, and these numbers here represent like the aggregate earnings of the S&P 500. So when you talk about a price to earnings multiple, this is the earnings level of the index, and these estimates have actually come down quite a bit since really the summer, when they were up in the kind of the 280, 278 range. Not that, coming down to 274 is that big of a jump, or that big of a decline, but needless to say, there has been a little bit of change in sentiment on estimates, and I do think that there is a possibility that those estimates could come down a little bit. So in this chart, we have from Financial Times really a measure of insider selling. And so you can see here in these red bars here, this represents the ratio of sellers to buyers. And so when the bars spike, that means you've got a lot more sellers than you do buyers. And that's exactly the environment that we've got right now. You can see the S&P 500 index, which is overlaid on that. And so, and I want to say that insider selling does matter. So, these are people that ostensibly have a higher level of knowledge, particularly on their own business and their own operating environment, their own economic backdrop, so on and so forth. And so you really do need to take note when you see insiders selling, and particularly to the degree that they are now. So I've talked about liquidity in the markets being a prominent factor in some of the valuations that we see, and this is really kind of in some respects another manifestation of that. So here on the left axis, we've got the percent of cash relative to total assets for U.S. equity mutual funds, and you can see that that's very low. It's about 1.5%. So mutual funds are definitely long, and just as we saw that, all of the international investors, domestic investors putting money in the market, and it really is kind of viewed as a feeding frenzy right now. And so you got these equity mutual funds that are pretty heavily invested. This is not symptomatic of, anything related to, hey, we're concerned about things, we're raising cash. No, they have it deployed. And then you can see in aggregate terms, on the right-hand scale, you've got overall liquidity for equity mutual funds, and it's still pretty high. So very interesting to see that, risk is on right now. All right, private equity balances. You can see that dry powder in the private equity markets is really, really strong. And it's been growing over a matter of years. And so when you look at the public markets and you look at valuations, a lot of these firms have a lot of dry powder, but they're having trouble getting out of current investments because that market is not very good. But what I try to do in tying these two charts together is to show you that there's a lot of private equity dry powder out there waiting for investment. And here you have Goldman Sachs that's forecasting 2025 a kind of a bump in mergers and acquisitions. And I think a lot of that's going to be driven by this. When they see that, they make this assumption that even though valuations in the equity markets are relatively high, there's still a lot of gains, embedded gains to be had. And so I think they're going to be prompted, they're going to want to deploy some of this capital in productive enterprises, and that's driving the M&A estimates a little bit higher for 2025. And so, the implications for this are, you might see some valuation support for publicly traded stocks, considering the fact that private equity has so much dry powder right now. So as we get close to the end of the chart pack, a couple of things that kind of pique my interest, if you will. You've got the share of group of seven nations, the gross domestic product. So the U.S. is definitely becoming more relevant. So for all the talk of China, and China has its own problems, which I won't go into here, but they go tie back to the former one-child policy, and they tie back to decisions which led to a lot of non-productive investment. But U.S. is very much relevant. Going back to 2010, you can see this interim trough. We've gone from like 45 to almost 60% of the group of seven nations gross domestic product. So U.S. is highly influential here, and and if you think that we're slipping as relative to the rest of the world, this chart right here will tell you that we're not. And in the final chart of the week, I been reading a little bit about some of the hot spots globally and the risk of armed conflict, and obviously in Ukraine there's actual armed conflict, but Middle East and some of these other areas. And it kind of made me think about water resource scarcity and how that's going to impact future belligerence on the part of nations. So you can see here that water conflicts have gone really up through the roof. And so when you think about the global supply of fresh water and the global capacity to generate fresh water from salt water and water desalination activities here, it is limited, and it's almost like this Malthusian type circumstance that we've got now, that you've got a lot of countries that are fighting on the basis of resource acquisition. And I think, I'm not going to wax kind of geopolitic here, but I think as it relates to the investment markets, this will have a little bit of bearing on the margin, and may have may capture a bit more of the headlines. But the fact that this has gone up at the rate that it has really does surprise me, and I thought I'd pass it along. Well, that's all we got this week. Hope you've enjoyed the chart pack. I hope you have a wonderful Thanksgiving holiday with your family. Be safe if you're traveling, and just enjoy life, enjoy family, and all of life's blessings. And I wish you and your family very well, and we'll see you on the flip side.